The broadcast is now starting. All attendees are in listen-only mode.
It's the 30th of September, last day of September, and my goodness, it's been a long time since we've had a Biznews Global Share Portfolio update. Today it's called the Share Portfolio, and it will be made known in just a moment, but thanks for being with us. First of all, though, let's make sure that we've got all of our technicals in the working the way it should. My colleague Stuart Lohman, who's our managing editor, manages those things. Stu?
Thanks, Alec. Always good to be here. I think we had our last Standard Bank one in January, so it has been a while, as you mentioned earlier. So it's good to have everyone back. Just quickly, if you can all hear us, obviously sound is the most important thing here. Can you just raise your hands? There's a little high five signal there if you can hear myself clearly and see the Biznews Share Portfolio screen in front of you. There we go, Alec, got lots of high fives. We also like to keep it quite conversational, and questions are put across to Alec as they come through. Just on the control panel on the right-hand side, there's a questions drop-down menu. You can write your questions, and then I'll prod Alec as we go through the portfolio and as he discusses certain changes. But it sounds like an exciting one, Alec.
Yeah, it certainly is. And just to make sure that I'm not a cardboard cutout, or that I do exist, let's just put my webcam on very briefly. There we go. You can see me. As you can see behind, I've got my Errol Boyley, my beautiful picture, and of course the bookcases that one would find from anybody who does what we do for a living. So I'm here. Look forward to chatting with you, and just to maybe kick off right in the very beginning. We have got a we've had an amazing performance. This portfolio has now been going for 5 years. Well, it'll be 5 years. It started in September 2014. Then what happened? There was a technical issue. We began with $200,000 as our number. There was a technical issue that they only loaded $100,000. So we began again in December 2014. So that's kind of the official beginning. In fact, if we'd taken it from September 2014, the numbers would be even better. But during this period of time, this portfolio has returned 34% per annum. So in the last 5 years, you invested here right from the outset, you would have been making 34% on your money in South African Rand. Looking at South African Rand, because that's what this is all about, we started this portfolio on the basis that it would be a hedge against Zoomanomics. We were very concerned about the fact that Zoomanomics was giving us the was taking us off track, was taking us into a area where who knows what would have happened to South Africa if Zuma had continued in his merry way. Well, thankfully that didn't happen, and we had a change in December, on the 18th of December 2017, and that's why I've put this graph up here, because this is really the overall context of what we're talking about, the Ramaphosa Rand. As you can see, there was quite a lot of confidence after Ramaphosa was won the elective conference, so very, very narrowly, as we all know. And the Rand improved when it goes down on the graph. That means that the Rand gets stronger. It improved to around 1170 against the US dollar from around 1270. And that happened in February when Ramaphosa was at its peak. Since then, it's gone the other way. It's stabilized in a channel between, as you can see there, between 14, I suppose you could say between 13 and 15. And if you are looking to invest in South Africa, you have to believe right now is a very, very good time, because the Rand is at amongst its lowest areas, at its weakest point that it has been since Ramaphosa came in. In fact, it's almost as weak as it was when Zuma was around. So these are, that's kind of the background. And we've made a decision to start allocating some of our money back into South Africa. So the portfolio, which has been completely offshore since we began it in December 2014, 5 years ago, as a hedge against the Rand, we now believe that there's an opportunity to be investing in South Africa. We haven't gone nuts. I'll show you that in a moment, but we have started to rejig the portfolio, in fact, restructure the portfolio quite significantly. Those of you who've been following BizNews's portfolios for a while will know that we did have a relationship with Easy Equities, where they literally gave you the opportunity to invest money into their portfolios. We've taken a decision to just stay with Standard Bank now. So Standard Bank are our partners. They've been our partners since the beginning. So all Standard Bank online clients, and of course BizNews Premium clients who are on this webinar, this is the only place you're going to be getting the BizNews portfolio in future, through Standard Bank online share trading, and of course through BizNews Premium for our members. So there's the Ramaphosa Rand. The view then being, from where we're sitting, that the Rand is now at a weak point and a good time to be investing in South Africa. Moving on to the next issue, it does look quite rough there. Just to go back there, you can see, although the Rand has weakened from around 11, well, let's call it 12.70 when Ramaphosa was elected, to over 15 rands and 15 cents this morning, it could have been a lot worse. And I love this graph. My friend from Standard Bank, Brett Duncan, has pointed me in this direction. For many, many years, the Rand and the Turkish lira worked in tandem. They were run by similar kinds of people, similar autocrats, who really did not know a whole lot about the right kind of economic policies. And you can see what has happened here is that the Rand has outperformed the Turkish lira by 50%. Put differently, had Mrs. Zuma and the Zuma dynasty continued after December 2017, today the Rand would be trading at around 21 to 22 Rand to the US dollar. Interest rates would be much higher. We would be looking a lot like Turkey. So things could be a lot worse. Here's our portfolio. It's been many months. In fact, as Stuart mentioned earlier, not since January have we done a Standard Bank portfolio or the global share portfolio a webinar. We've done a number of webinars, of course, this year, but we've been working on a broader partnership between the two of us, and these things do take time. The partnership, by the way, is such that if you are a BizNews Premium subscriber and you become a Standard Bank online share trading member, you get a 30% discount off the monthly fee. If you are an online share trading member and you take out a BizNews Premium subscription, you get a 10% discount. So if you happen to be in either of those camps at the moment and you want to take advantage of this fantastic opportunity, our reward to, or loyalty program, if you like, just sign up for both. Once you sign up for both, we'll give you the benefit. Standard Bank will give you the benefit, and BizNews will give you the benefit as well. If you happen already to be in that situation, just let us know and we'll adjust the billing accordingly. Okay, so there's the portfolio on the 27th of January. Now, this is really fascinating. We hit a peak in US dollars on the portfolio of $390,000 in September last year. You might recall that was the so-called bubble in the US stock market just before the sell-off, the very sharp sell-off that began in October and took the share prices in America down substantially to, in fact, early December, when they then started stabilizing and turning around. Many so-called experts said it was time to get out. The market was crashing. Share prices would not rise again. And we did see some wonderful opportunities for those who had the foresight to make the investments during that period. As far as we are concerned, we decided to sit tight during that period. And of course, in the short term, there was quite a reverse. As you can see there at the bottom, portfolio value September, $390,000, October, $336,000. So that was a big wipeout. January, it had stabilized at $346,000, but today, a year later, $382,000, a decline of just 2% off the September all-time high of the American stock market. Part of this reason, a big part of this reason, has been the performance of our dear friend Amazon.com. As you can see, we bought in there $327. We've held on. We haven't changed a single share in that holding, and it's come from about 8% of the portfolio to 23% of the portfolio, and we have no intention of selling those shares now either. Apple, we're also sticking with. After a very, very bumpy start, Apple has given us, in US dollar terms, a 76% rise. And the market overall, and that, by the way, was Apple we got in late and bought, we only bought it 6 months into the 2015 year. And if you have a look at the comparison over the period, Vanguard VOO, that's the S&P 500 index, that's the market. The US market in dollars is up 44% in 5 years. So Apple's outperformed the US market. Amazon has crushed the US market in performance stakes. Microsoft has well outperformed the US market. There, we've only been in the stock for 2 years, and it's already generated 79%. Berkshire has underperformed the US market very slightly, and Adobe Systems, which we only invested in about a year ago, has kind of level pegged the market. In January, our decision was to sell out of Alphabet or Google and to put money into the 2 banking stocks, JP Morgan and Morgan Stanley. And both of those, as you can see, had very small shareholdings. The reason for that was that our strategy is always when we buy, we stagger it over 3 months. We've done it differently this time because we've restructured the whole portfolio. But generally speaking, if you're going to buy into a new stock, the way we've always done it is we've bought it over 3 months. I hope I'm not going too quickly, Stuart, but let's just go back to what we've done now. So,
Alec, can I just stop you on, because you were speaking about the holdings there. Catuccello wants to know, obviously Apple, you mentioned up 79% there. Is it still a 76? Sorry, is it still a good buy, or has she missed the boat during the recent fall?
Our view on this portfolio is that it gives you a model from which to work. So when you have a look at it, if you're going to invest 15% of your portfolio into Apple, this is the way it was. I'm going to recommend something very different. Remember, this is where we came back to January. So perhaps we can talk about that or address that question in just a moment. But effectively, this portfolio is the way we think you should be investing your money. So if you're investing it today, I still think Amazon is worth putting 23% of your money into at $17.25 a share. I hope that that kind of clarifies it. So yes, you haven't missed any boats there. These are these are long-term bets, long-term investments, and we do, every time I try to play things in the short term, I always make a mistake. But in essence, we really are looking to buy and hold, or as Warren Buffett would put it, his holding term is forever. So I would suggest that it's a forever bet here as well. But let's just continue. That's our decision now, is to lighten our global holdings. Getting back to what I said earlier, I think it's a good time to be investing in South Africa. We've got a couple of really nice bets that we're going to be making in South Africa, or investments rather. I should get away from saying bets. And we have subsequently decided to sell out of these stocks which are in the portfolio. JP Morgan, which we'd only held since January, a nice profit there. Morgan Stanley, which has done pretty much nothing, but at least it hasn't lost money. Tencent, which we've been invested in since May 2017. The reason we're selling out of Tencent, it's not that we don't like Tencent anymore. It's because we're going to take a big investment in Naspers on the local market. Vanguard, which is the S&P 500 index, we're switching from the Vanguard S&P to a South African top 40 index in effect. And Alibaba, we are selling out of Alibaba. I'm still worried that although Donald Trump is trying to play this China trade war story so that he can get it all sorted just before the re-election, or his potential to be re-elected, I still worry about whether something could go wrong there. And the way the Chinese and the Americans are shaping up to each other, it can't be good for Alibaba on American stock markets. This last week, Bloomberg reported that Donald Trump is now threatening that Americans will not be able to make portfolio investments into China. Now, if you it's one step away from saying you no longer can invest in Alibaba and, well, Tencent have only got Tencent Music listed on the US market. But it's high risk suddenly. And to me, there are far better options. So we've lightened our global holdings. Just to give you an understanding, though, we don't sell much. This in the 5 years. These are the only stocks that we've actually sold in this portfolio. you can count them, well, on 1.5 hands. Nova Nordisk, which we held for 2 years, we sold. It's subsequent to us selling. It's up 18%. Barclays is down 31%. So we got at the right time. IBM, we sold, is still down, even though that was 2.5 years ago, roughly, down 6%. Our big landmine that we managed to get out of, even though we took a very small loss on it, it would have been down 94% today had we held on to Metro Bank. It's a great company, but it hit scandals. And once the whiff of scandal came through, that's when Warren Buffett says, get out. And the scandal, when the whiff of scandal came through on Barclays, you might remember what happened there was that a whistleblower was attacked and targeted by the chief executive, who himself has subsequently departed. But it just gave you an idea of the culture of that organization. We didn't like it. We wanted out. IBM, we sold when Warren Buffett sold. You can't really get a better insight than that. Metro Bank, we got the whiff of scandal there as well, when the wife of the chief executive was accused of spending money that hadn't been allocated by the company. So thankfully we were out there at the right time. Tesla, you might remember what happened with Elon Musk and his tweets and taking on the SEC in America. It was just too much for us. We were out there at that stage. Facebook, we sold probably far too early, but it doesn't matter. I'm happy not to be invested in a company that does things like Cambridge Analytica. And Alphabet was there was no scandal there. It just was a feeling that we'd run it's run its course. We'd almost doubled our money there. They were getting quite a lot of headwinds coming out of particularly Europe with fines, etc. And all round, the money that we did sell on these shares and allocate elsewhere has really performed far better than staying in there. So who have we brought in? Well, on the international side, Netflix. Those of you who've been following the portfolio for years will know I love the model. I love the network model. Anybody who's used Netflix will know that it's unbelievably good value. And as a consequence of that, we've been watching it, and we've been watching it, and we've been watching it, and it's always been too expensive. And then at the last quarter, and you can see that around about the 22nd of July, at the bottom there, and those big volumes that came through. In the last quarter, they came out with financial results that disappointed badly, and the share price from being above 350 dropped to almost 250, where it is at the moment. There are quarterly results coming out soon. My sense is that the executives of Netflix are not going to make the same mistake twice, that they will have managed expectations this time around. It's a phenomenal model, and it's right in our sweet spot in what we believe in, the exponential ability of the network effect. So Netflix, I've wanted to add it to the portfolio for a long time, and at last we now have that opportunity with the share price trading where it is at the moment. So we've bought in there at $263 a share. We've allocated $26,000. Just to have a look at the arithmetic as it's got it on the screen there. The total sales from the cash raised from the sales of those stocks that I mentioned earlier was, as you can see, just about $100,000. There was $45,000 in cash brought forward from January. So we have about $150,000 to allocate. I'm trying to put more money into the South African market, but Netflix is just too appealing from the approach that we've had and the success that we've had with exponential companies. So we've made an investment into that this time around. We're also buying into South Africa. And when you have a look at this, this is a 5-year graph of the South African rand going back to roughly when the portfolio began, when the rand at that stage was just over 11 to the US dollar. Now it's over 15 to the US dollar. As you can see, at the worst of the Zuma era, it got to almost 16 against the US dollar. That would have been the time to, well, bring money back into South Africa if you'd known, but that's 3 years ago, and I guess you'd have had a pretty bumpy ride over that nearly 4 years ago. We now think that the country is a very, very different place to the one that was being managed or mismanaged back then. I'm a strong believer that the way ahead for South Africa is brighter, and as a consequence have been looking for an opportunity to diversify the portfolio and bring it back into South Africa. Now, the best bet you can probably ever make on the JSE or on South Africa is Naspers. Reason for this is that Naspers now has, you might recall, it's been spun off. We've got Prosus, which is sitting in Europe. Prosus is a focused internet global play. You buy into Prosus in the Amsterdam market. Only stocks or exposure that you have is non-South Africa, and you get direct exposure into Tencent and the other assets that Naspers has around the world, and it's got substantial internet assets. However, if you buy Naspers itself, which owns about 3/4 still of Prosus, you get a South African discount. So if you believe that South Africa is going to be a better country, or that it'll start normalizing, and that the rand will improve, and that the Ramaphosa long game actually plays off in the South African economy, then the way to position yourself for that likelihood is to buy Naspers shares, because when you do your analysis of Tencent, that's really what you're buying into via Naspers, but you're just buying it at a discount. So you're buying Tencent effectively, and lots of other assets thrown in for free at a discount because of the South African factor. I hope that makes sense. But what I'm saying here is that as South Africa normalizes and the rand improves, Naspers will be one of the Naspers stock will be one of the big beneficiaries, on top of which Naspers' major asset being in Tencent, a company that I followed for a long time. And just to put it in perspective, Tencent is like owning Facebook with WhatsApp and its social media, Google with its search engine, and adding on a whole lot of music and on top of that, and financial services. So you really are, antitrust legislation would not allow Tencent to exist in the United States. But in China, they look at things a little differently. They're more keen to have national champions. And as a consequence, this phenomenal company is very, very well positioned for the future. So that's the reason for buying into Naspers, a substantial slug here. Also, we've gone for the StanLib Top 40 ETF, or Stan 40, and that is a very, very low cost exchange traded fund, which gives you a investment into the top 40 shares on the Johannesburg Stock Exchange, which are the ones likely to benefit most from an upturn in the economy, or at least a stabilization on the situation we're in at the moment, or the bad news. Once the bad news starts moving out, and if you like, those green shoots of recovery start coming through, this will be a big beneficiary. I've kept nearly R500,000 in cash, so we've brought the money back into South Africa. Next month, or in 2 months' time rather, when we talk about this program, we're not going to then say, oh, well, you know, we've got this in dollars. This money has been brought back into South Africa. We got nearly R500,000, and we brought it back at 15 Rand and 15 cents. So that's how the portfolio is, just to give you a little more of an insight into those two. On the left-hand side is the Naspers share price, which has been adjusted for the departure of Prosus. And as you can see there, Naspers has, during 2018, it underperformed Tencent quite badly, but it appears, given the work that has been done now in the international community and the higher profile that Naspers has, that it's starting to much more closely work with Tencent. Sure, it's only been for a few months since the listing in Amsterdam, but it does appear to me that it's unlikely that one's going to see these massive discounts that we had in the past. And, well, we're buying into Naspers at a wonderfully cheap discount, around 40% to what the Tencent share is worth. There's no doubt that people in other parts of the world will also find it as a cheaper way into Tencent. On the right-hand side is Stan 40, or the StanLib Top 40 ETF on the Johannesburg Stock Exchange. And as you can see in that one, that is a graph that goes back right to 2014. And as you can see, the where we're buying in is at a pretty reasonable level. The Aussie 40 has done very little in the last 5 years. We do expect, and certainly it's done really poorly in the last 2 years, but we are expecting that to be better in the future. The whole idea is to be buying when everybody else is selling, or buy low, sell high. It sounds simple, but you have to have patience, and you have to have sometimes quite a bit of perseverance. But here we go. Looking at the portfolio as it now stands, with the addition, you can see the global stocks. Some of the global stocks are out. These are the global stocks that we're holding on to: Amazon, Microsoft, Berkshire. Who could sell Berkshire? Even though it doesn't really fit in our exponential portfolio of focus, Berkshire is still, it's such a solid company. And well, you know, if you've got Warren Buffett working for you, who needs anybody else really? Apple and Adobe, and then adding in Netflix. So of those stocks, 5 of them are exponential companies: Amazon, Microsoft, Apple, Adobe, and Netflix, all of them positioned to benefit, as they have done for some years now, from the network effect, from the change in the environment around the world, from the new world, if you like, and how these tech-driven businesses, and I emphasize businesses, because there are a lot of tech-driven companies that aren't really businesses, as we've seen recently, but these are tech-driven businesses, how they will continue to thrive into the future, or at least we think so. 7% of the portfolio being put into Netflix, and then added big chunks in Naspers for the reason I've articulated now. We have 12% of the total portfolio in it, and 12% in the Stanlib Top 40 ETF, positioned both of those for an upswing in South Africa's status around the world. As you can see, we started on the 5th of December at 11 Rand 27. So the Rand has added 13 percentage points to our annualized growth over the last 5 years. We've got an annualized growth here of 32% on this portfolio. Wow. And the US dollar growth, of course, of 19% has also given us quite a lot of support. But if we'd just put the money into US dollars, we would have had an annualized return of 13% a year. The whole idea was to, instead of just putting the money into US dollars, or as many people do, just take money offshore and put it in a bank account, was actually to invest it into the US stock market and to try and find a couple of winners, in addition to investing a chunk into the market as a whole, which we did through the S&P 500 index and through the Berkshire shares. And it's paid off. It's paid off handsomely. And as you can see there, in the last year, the Rand's decline has given this portfolio, was taken this portfolio to a record, up 8% on the peak that was reached in September last year, before that almighty crash happened on Wall Street. So, well, I suppose not an almighty crash, but you know what I'm talking about, the turnaround or the decline there. So the portfolio value, which went down from 5.3 million to 4.7 and then 4.5 in November and in January, is now up to a record 5.793 million. And we started this portfolio, as you can see on the left-hand side, with 2.25 million Rand. Actually, we started with $200,000, but the equivalent was 2.25 million Rand. So it's been incredible. It's been an amazing ride. We've been very, very lucky to get out of some stocks that would have hurt us, only by using the principle of when the scandal begins, you just run for the hills. And we've also taken a view that everything that we invest in, we do a lot of homework before going into it and know exactly why we are making that investment, and follow the Warren Buffett principle of holding forever. There's the individual stock performances. As you can see, thanks to Amazon.com, I guess we should all be sending Christmas presents to Jeff Bezos at the end of the year to say, well, thank you very much. You really have changed our view, our financial situation in this portfolio. Almost like every South African should be sending a Christmas present to Koos Becker and thanking him for what Naspers has done to their retirement funds. But it's the Rand dollar has been pretty useful as a support, but generally speaking, the outperformances come from Amazon, with some nice performance there from Microsoft and Apple. We've had some dividends as well in the last, well, since we were in our last portfolio, we've had a few dividends that came through. We've added, there's about $1,000 that was added to the portfolio. And there it is, the new look portfolio now sitting with about just over $380,000, and that is the equivalent of almost 5.8 million rand. The rise in US dollars since we started was 91%, in rand 157%, and that's the annualized figure that we have there of 19 and 32%. And that's the presentation as I have it for today, and we're looking forward to some questions now. But just to remind you about the roadshow before we get into the questions, if you go to Standard Bank Online Share Trading homepage, you can see it there down the bottom. I just did a quick screenshot down the bottom there, Joburg, Cape Town, Durban. The roadshow begins on Tuesday, that's tomorrow, at the Glenhove Rose Conference Center. You must book. So they won't let you in if you don't book, if you're a Standard Bank client. But go along there. If you book and you come, you won't be charged. If you book and you don't come, you will be charged 250 Rand. So, and the reason for that is that it stops people taking up places that other people want. We will obviously answer questions now, but tomorrow evening, and then again in Cape Town on Wednesday, and in Durban on Monday coming, we'll be in a position where we can engage. I'll try and get there a little earlier and always stick around afterwards, and we can take your questions, your individual questions, if you don't get them through now. For Biznews Premium members, if you would like to come to these presentations, please drop Jeanette at biznews.com a line now. Drop her an email, tell her which one you'd like to come to, and she'll arrange it. We've got a limited number of tickets, but we will be able to do our best to get you, and certainly we've got enough. If you act quickly, you'll be able to get to those presentations. It's only about an hour, but it's always a good show and always pretty full. So if you'd like to come and you're a Biznews Premium member, but not yet a Standard Bank Online Share Trading account holder, you need to write that email to Jeanette at biznews.com. I think it's JANETTE at biznews.com, and she'll sort it out. Right, Stuart. So I've been doing a lot of talking for the last half hour. Do we have questions?
Excellent, thanks, Alec. Yes, we've got a few, which is great stuff. I know you mentioned it, but Arrested just wants to know, why sell Tencent if you buy Naspers?
Well, that's the reason for it. What we are doing here is that we are taking you don't really want to double up on Tencent now, because Naspers is effectively buying into Tencent. Why we're buying Naspers here is the added advantage of a benefit of getting in at a very low rand and at quite a big discount, a bigger discount than you would through Process. So if you like, we're swapping 10-cent shares in the dollar, and we're paying 60 cents for them.
Cool, thanks, Alec. I think that's quite a nice, simple reason. Paul just wants to know, if the rand strengthens because of the Ramaphosa vision plan, don't you think Naspers will go nowhere because of the currency play? Or do you see the share increasing due solely to investors waking up to that discount you mentioned?
No, I think the play here is that Naspers at the moment trades at a discount to Process. So, and a significant discount to Process. Process, this is unpack this. What happened was that Naspers' executives were unhappy that the shares were trading at such a huge discount to their assets. As we've mentioned before, you could buy 10 cent directly at 100 cents in the dollar, or you could get the same exposure at 60 cents in the dollar through buying Naspers shares and get everything else of Naspers thrown in, delivery, hero, classified ads, huge amounts of other assets that are put there. Clearly, the Naspers executives weren't very happy about this, and they were trying to find a way that they could unlock that value. The way they saw to unlock the value was to have a listing overseas, which effectively Naspers remains, the Naspers we know, it remains, it holds 3/4 of the equity, but the listing overseas has no South African connection. So that company is called Process, and Process trades at a significant premium to Naspers. So whereas Naspers would have a discount of, say, 40% to 10 cent, Prosus would have a discount of 30% or even 28% to the underlying holdings. And as South Africa improves, and the reason there's such a big difference there is because international investors say they don't want to invest through a South African vehicle because they're a bit nervous about the country. As South Africa's reputation improves, that discount will narrow. So that's really what I'm saying here. The reason then would be to buy Naspers because it will benefit, all other things being equal, due to that discount narrowing. Hope it isn't too complicated, Stu.
Cool. Thanks, Alec. EJ has got a comment here with a little question. It says, according to Anthea Jeffrey, The People's War, the ANC may not be inclined to solve unemployment and economic issues with Ramaphosa not having strong political support. How do you foresee an economic turnaround for the country?
Sure. Anthea Jeffrey is very smart, and she's got lots of opinions based on fact on the way she sees things. The way I see things is a little different. I'm of the view that there is a concerted drive by the Ramaphosa administration to solve unemployment. If you consider how he himself, when he was the deputy president, when he was really been given a lot of horrible jobs to do, he invested heavily of his own time and through his foundations in building libraries. Now, you don't build libraries if you don't want to educate people. And if you don't educate people, then you can't have jobs. So it's very, very close to the hearts of pretty much everybody who is looking for a future of South Africa that will be a better country than the country that perhaps was inherited. I don't know, you're getting into the realm of politics now, but to assume that the Ramaphosa administration doesn't know what it's doing, I think is a little bit, is actually disingenuous. I'd like to point you to the group that was put together on the economic panel that Cyril announced, I think it was last week. I had a look through there, and at first blush, I was a little bit concerned because there are they're pretty much all academics. So it's a doctor of this and a professor of that, including, by the way, Mariano Mazzucato, who, those of you who followed our reporting from Davos and subsequent to it, indeed in the last roadshow that we did, I mentioned Mariano Mazzucato, and she's on this panel, and she's one of the star economists to emerge in recent years, and has some very interesting thoughts on what is called the entrepreneurial development state. But the more I thought about it, the more I realized that something I was told by the professor of Northwest University, and it stuck with me many years ago. She said that the only people who have time to reflect and read nowadays are journalists and academics. And that's what the country needs. The country needs a lot of reflecting and reading and analyzing of data and checking things out and crunching the numbers and being sure that we do take the right direction. There's so much simplification of economic policy. Just close SAA and cut the minimum wage and we're going to have full employment. That kind of silliness. Doesn't work like that. We live in an incredibly complex world, and in a complex world, you need to have people really thinking about it and finding the right direction. Now, we have got the National Development Plan, which has been dusted off. That's what Tita Mboweni has been talking to. That has been supported by the ANC National NEC, National Executive Committee, at their meetings over the weekend. So we're all on board now. We know where we're going. We know what the plan is. We've got a bunch of really smart people on the economic advisory panel who are helping to advise and will be waving flags when we go in the wrong direction. So, yeah, I mean, Anthea Jeffrey is very clever and she has her views, but I would not simply disregard all the work that's being done by some very, very good people.
Excellent. Thanks, Alec. There's more on the investment side. Luzani just wants to know why the standard top 40 ETF and not something like Satrix or, there's a whole host of providers for this specific ETF type.
Yeah, it's a good call. Well, first of all, Standard Bank are our sponsors, so we need to, support our partners. But on the other hand, I looked at it very carefully, and the all-in cost here is it's under 30 basis points. I really like it. You can't 30 basis points. It's one of the cheapest in the market. So low cost. As Buffett says, you've got to be very, very mindful of cost. By the way, 30 basis points, I think they're at 0.28% was the all-in cost there. So when you're buying an exchange-traded fund, you really are buying an index tracker. The idea is to get the cheapest possible one that you can. And this is a good one. This is a good one. So those are the reasons.
Thanks, Alec. Lipe just wants to get your perspectives on these unicorn startups that are currently looking to list on the US exchange. I'm guessing it's referring to WeWorks and Uber and stuff like that.
Yeah, that's a good question. We've been covering a lot of it on Biznews Premium recently, in particular in the premium section. And WeWork are also involved in South Africa too. It's been a monumental disaster. There's a charismatic individual from Israel who got together with a partner, and they really just became very popular amongst investors, including SoftBank from Japan. And the investors threw money at them, and they threw money at landlords, and they built up a portfolio of $47 billion in lease obligations. Now that's fine as long as you get people to come in and take up that space that's at a higher price than you're paying the landlords. But when that turns and when people stop coming in other words, when the music stops, you could be in a very, very deep spot of bother. Something that did concern investors was that the founder, Adam Neumann, cashed in $700 million of his own stake in WeWork. It's only been going for a few years. And he's made $700 million already before the IPO. So it doesn't send a very strong signal of a long-term commitment to the company. He's, of course, been fired as chief executive. I think he's now become a non-executive on the board. So, but he's got $700 million. So for him, he's probably moving on to his next thing. Some of the other newcomers to the market, I just worry that their business models are not really there. Uber, incidentally, is not amongst those. I think Uber's got a strong business model, but they are going to have to find a way to turn that into profit. Whereas when you look at Netflix, which we've added to the portfolio, although they're losing money or they are developing, they're investing heavily in development, Netflix has got a stranglehold already on a very important part of the sector. And all they need to do is just bump up the price a couple of dollars and it'll be extremely profitable. A bit like Amazon and a bit like what Google did in the early days. While they were developing and building their networks, they paid a lot of money for it, but they knew always in the back of their mind that they had the ecosystem. They needed to switch it on. The cash would flow. So you've got to be very, very, very careful about newcomers to any market. I lived through it in 1999. I brought MoneyWeb to the stock market in Johannesburg. We believed at the time that the internet was going to take over everything, that there would be no newspapers in a couple of years, that everyone would be going to the internet and that we would just be printing money. Well, we had the crash of 2000 and the Nasdaq crashed first and other markets followed suit. And from R2.30 share price at MoneyWeb just after we listed, I saw the shares trading at 16 cents in a couple of years. As it happened, it was a much better business in a couple of years than it was when we listed. But we listed at a time when everybody just wanted a slice of the internet. And we fortunately were able to keep the company going. And, well, it's a long story, MoneyWeb, but it just gives you, having lived through that, there's a lot of what's happening at the moment that reminds me of what happened during the dot-com bubble, where just about anybody with an idea seems to be able to raise money. We had this Peloton thing, health clubs or health instructors, kind of a new age version of Virgin Active, and that came to the market with a lot of hype and, of course, collapsed. Just to put it in perspective, WeWork was being valued in the private market for almost $50 billion. Now they say, after the listing has been pulled, and they're going to have to come back sometime, now the public market is saying they'll only value that at $10 billion. So 1/5 of what people were prepared to pay just a few months ago. It looks very, very suspiciously like the bubble is bursting, or at least that the air is escaping.
Excellent. Thanks, Alec. I only just want to know, what do you do with your dividends received?
They go into the portfolio. If you have a look back here, there we go. There's the dividend. We've only got two, well, we only had two dividend payers. I suppose Naspers pays a paltry little dividend as well. Vanguard's now out the portfolio, so we won't be getting that. Apple has been paying. Look at that. It's quite an interesting table, this, because you can see that in 2015, Apple was paying 52 cents a share. That's when we bought it. It's now paying 77 cents a share. So the dividend has really gone up pretty nicely, by 50% in the last 5 years. So it gives you an indication, although it creeps up slowly, it does definitely make a contribution. So what we do with the dividends is we just add them back into the cash.
Cool, thanks, Alec. Fritz just wants to know if you make use of ratios when selecting your stocks. He's picked out like PE, PEG, quick, sharp ratios, but he doesn't. If there's anything you use when you look at this sort of stocks.
Fritz, that is not something with this portfolio that we've used. I did very much in the past when putting together the SA Champions portfolio. It was a value-based portfolio, but this one is exponential. This is more on a view that the world has changed, that things like network effects, the guerrilla game, when you get scale, and you can use technology to benefit from that scale, that is the kind of business you should be investing in. The problem with PEs is that quite often the E drops away at the worst possible time. And what looks like a very cheap stock suddenly becomes very expensive. It's the same thing as EBITDA. I hate EBITDA because, having sat on the other side running a public company, I could see how easy it would be to manipulate EBITDA by capitalizing certain costs, and then you take them straight off your bottom line. It's a bit like the banks. When the banks decide that they need to boost profits in a particular year, they have their bad debt write-offs a little lower than they would have otherwise, because that's a direct hit to profits. So all of these ratios have got their place. And certainly with value investing, you definitely can. If you can find a stock or a company, we mustn't say stocks, a company, because when you're investing, you're becoming a co-owner in the company. If you can buy into a company that you can see is going to be delivering a steady rate of return into the future, and Buffett says you've got to look at 5 years into the future. That's why he's been so reluctant until recently in investing in many of the companies in the new technological era, if you like. If you could do that, if you find a brickworks, and you know a brickworks is going to produce 100,000 bricks a year, and it's going to make $1 a brick, so you're going to make $100,000, and you're sitting there, you can buy that for $500,000. Well, you'd buy it, wouldn't you? Because you know that you're going to be getting your money back in 5 years' time. But there are fewer and fewer of these dead cert type businesses around nowadays. And much of society and industry has been disrupted by technology. Look at the banks. The banks are doing, well, they've got a lot of benefits with their network effects, etc. But they're also, in their traditional areas of business, they are being attacked by technologically driven businesses, and the banks themselves have got to adjust for it. So my feeling on PEs, they got a place, and it's also to see what it is relative to what you were getting out of the stock in the past. But it all comes down to me, it's intrinsic value. If you're looking for a value stock, what is the intrinsic value? Buffett tells us that intrinsic value should be based on how much cash you can get out of a company. It's just like anything else that you invest in. If you're putting in $100, how long is it going to take you to get that $100 back? If the company is generating a certain amount of cash, then you can put in a discount ratio. You can work it out in a very simple spreadsheet to see exactly what that return is. But if you start with an intrinsic value, then buy the stock at a discount to your intrinsic value, 20 to 30% is a useful ratio to work from. You're probably not going to go wrong. That's what Buffett also calls a margin of safety. But to just buy something because the PE is low eliminates or ignores lots of other issues, lots of other complexities, which could actually trip you up.
Excellent, thanks, Alec. Just a few questions around future events. So Lipe says you've got concerns about a US or global recession, and then Chris just mentions the potential downgrade in South Africa in November from Moody's.
Yeah, the downgrade is an issue. It's going to certainly hurt the country should the downgrade come through, but it seems to not be a one-way bet. It also seems that we have had a lot of progress in addressing the issues that the ratings agencies and foreign investors are wanting. So I think there would be an impact from a downgrade, but it isn't a certainty by any means, in the same way as those who've been calling for or saying that the IMF will be moving into South Africa and having to bail South Africa out. That's not a certainty. I liked what some of the economists, Darby Ritt, I think, did a piece on this recently with our colleague Linda van Tilburg, where he explained why he didn't think that was going to happen. Often in our country, in South Africa, we're our own worst enemies. We get into depths of despair at one moment and then get completely euphoric thereafter. What we got to do is to try and see through the noise and come to conclusions as an investor that if you're going to be able to buy cheaply after, or more cheaply after November, because there's going to be a downgrade, it's a hard one to call. Warren Buffett says he doesn't look at the big picture. He rather focuses entirely on the companies themselves. And when I look at Naspers, I'm very happy with that. We've looked at the big picture, if you like, with the Stanlib Top 40, but South African corporates are in excellent shape. They've withstood a recession or recessionary conditions. They're ready now. They're getting more creative. They're looking as a gateway into Africa, and they got a lot of cash on their balance sheets. So it's not heavily indebted companies that are going to get hit by a increase in interest rates, which would come with a downgrade. So, corporate South Africa is in good shape. As a consequence of that, maybe the uncertainty of Moody's getting out the way might paradoxically be a good thing for the country. But I mean, clearly we don't want to have a downgrade because higher interest rates mean we all pay more. But when you're investing, try not to get caught up in the noise and in assessments and assumptions. You know, I love Nassim Taleb's work, and he keeps telling us, and he does a lot of analysis on this, that the people who forecast, the people who project the future are so often wrong. Most of them are wrong. And he said he doesn't understand why we still listen to these guys who make projections into the future. Much better, be like Buffett, go and have a look at what you're buying into, what you're buying into, and then take it from there.
Excellent, thanks. I've got a few questions on specific SA stocks. I know David and yourself have spoken long about Sasol, but Paul wants to know what your thoughts are. Any upside long term?
Yeah, there has to be. Any stock that's down 50%, and in fact is trading at lower than the value of just the one project that has caused all the trouble has got to be reconsidered. Has got to be considered as a prospect. Sasol, remember, is highly geared. Its cash flows are to the rand value of oil. The rand having weakened the way that it has, the oil price having gone up the way that it has, Sasol's printing money at the moment. Of course, what it's printing is going off to pay for the Lake Charles disaster. Is there a clawback? Is there some kind of a liability? You know, these Sasol guys are very smart to assume that they've been taken for a ride on this and won't have any way of at least getting some of the cost overruns back. I think is a bit naive. The thing that worries me about Sasol, really worries me about Sasol, was that they had a chief executive they got from Fluor Corporation. The project in Lake Charles was promoted by this guy. He then appointed Fluor Corporation to do the engineering and the speccing and basically to do the project. He was fired by Sasol, and then he went back to work for Fluor Corporation. So I don't know. We could see something interesting developing from that. Just doesn't seem to make a lot of sense to me. But Sasol is fundamentally a very, very strong and a very good company. Lake Charles is hopefully just a hiccup. They've done many other big projects that they've brought to market pretty successfully. This one has been a blot on the copybook, but I do like the way that Sasol's board is addressing it, that they're looking at it responsibly, that they've postponed the financial results twice now so they can get to the bottom of it all. And you can be sure that when they do, that'll be the time to really study this and probably find that you're buying to the shares at a pretty good discounted price. But I suppose while that is still out there and it's uncertain, we should really wait for the information before we make an investment. Remember, you're not punting on shares. You're not taking a bet. You need to be looking at valid, provable information, and the company will give you that. When it does come out, read it, analyze it, and then make your decision.
Excellent, thanks, Alec. Our question is quite general, but I suppose is there any other SA single stocks you're looking at or assessing?
Yeah, a lot. I was looking at Italtile the other day, and it's a fantastic entrepreneurial company, which I like. I love Spur Corporation. I think that they're also at a stage, at a point where you might be reinvesting in it. I really like, as you probably know, Wilson Bailey. I felt that the share price was overdone, the knockback there. And of course, it's a bit late now because I was looking at that one too. It dropped from about 160 down to about 110. And that was on news from one steel project in Western Australia, in Melbourne, the Western Roads project in Melbourne, which wiped out the profits for most of the profits for a year. But it's such a strong company. And if you consider that it's the last man standing in South African construction, it was jumping out at you. Well, unfortunately, it's jumped a little bit before we could do anything about it because it's sitting at 140 now. So it's gone up 30% since that analysis. But what one has to do with investing is the same as with life. Just do your homework. Don't accept what the crowd is telling you. Don't believe what people are talking about. Go and check it out. Be skeptical. Ask the difficult questions. Ask the questions that might indeed make other people think that you're the fool buying into a particular share at a price. Look at Netflix. We could have bought Netflix at $350. We didn't. We held off until the time was right. And I think it's a similar situation with every single stock. Do your homework, look at them. There's another one, Afrimat. I really like that business. Very, very well managed, well run, good entrepreneurs. They stepped away from a deal that they were very keen to do in Australia, stepped away from it because they felt that there wasn't value there and that the returns weren't as high as it could be. Now, I know many, many companies in South Africa who've done deals in Australia, UK, other parts of the world simply because the executives had an ulterior motive in doing those deals. Whereas in this case with Afrimat, they looked at it, it wasn't good for shareholders, they walked away. Often, if you can see a company that walks away from a deal rather than making it happen, even though it would be a more comfortable transaction to have that done, that's the kind of company I like to be invested in. I want the managers to be acting like shareholders. And if you can do that, and you know that they are looking at things the same way you're looking at things, then you know that you're getting a very good ride for the savings that you've put into that company.
Excellent, thanks. Like I see we're coming to an hour, so just to wrap up, I've got a few quick ones. We just want to fire them. One from Charles. He wants to know your thoughts on Old Mutual, obviously with the see the shares gone down. He says 21% discount sounds good for the long and short term. There's a question on digital currency, and then someone just wants to explain the Standard Bank business partnership again, please.
Okay, so Old Mutual, it's a mess. And I love what Trevor Manuel and the board are doing. It will pass. They are doing the right thing. They are, but it isn't popular because it is a distraction. So what they've done, the approach that they've taken, is going to stand this company in good stead into the future. Because you had a situation, any way you want to read it, where the chief executive was doing things that the board wasn't happy about. Now, I was reading, and funny enough, I was reading Warren Buffett's 2003 annual report to Berkshire Hathaway shareholders last night. And he spoke in there about boards of directors and what boards of directors should be doing and how they should be aligned with the company, with the shareholders of the company, and how they should have the courage to be able to keep the company's culture in the right direction. It's not popular. Many boards of directors are brought in, as Buffett says, they make as much of a contribution as a pot plant would sitting in that chair. But he says that he goes for something different, and indeed Old Mutual have shown, the board of directors at Old Mutual have shown that they have got their hearts in the right place. They are doing exactly what a board of directors needs to do, which is protect the culture of the company in the long term, protect the integrity of the company in the long term, even though they're getting quite a lot of flack for it in the short term. So it is a mess, but it'll come through stronger. And if you can analyze the Old Mutual balance sheet and operations, and if you like the business that they have, then you're probably going to be getting a very, very good price, or you'll be buying in at a very good price right now. And I haven't done my homework on that one, so I can't tell you whether or not I'd be following you. But if you work out your own intrinsic value, because of the issues that have been happening there, and this is not a scandal in the sense of a Elon Musk or a Novo Nordisk or some of those Metro Bank. This is a scandal that is a good thing in many ways. Or it's what is being pursued by the company is the right approach. So I wouldn't get that to put me off. Digital currencies, I just revert back to what Nero Rabini says, that it's the biggest con. Bitcoin is the biggest con known to man. And I'll also tell you that I attended a conference in London by Offshore Alert, where this is David Marchant, who's a real big, heavy hitter in this field, in the offshore tax haven field. And he had, speaking in the one session, the head of investigations at the IRS, in other words, the tax man in the United States. If I recall, he's got something like 20,000 people working for him. And his equivalent at HMRC, which is in the UK. And both of them were totally outspoken on digital currencies. And they said that over 90% of the trade in digital currencies, because remember, you can't trace it, over 90% of the trade is done by criminal syndicates, by the underworld. And as a consequence, they were finding ways to attack it. So if you've got that against you, and you want to buy into digital currencies, the Bitcoins and the like, just know that you've got a very, very big mountain to climb. On the one hand, it's being abused by criminal elements. On the other hand, because of that, you've got the authorities who are trying to squeeze it back. So it doesn't make a very happy picture for those who are investing in those currencies. And Stu, I've forgotten the last one.
Oh, no, thanks. It's just the quick explanation of the Biznews Standard Bank partnership with regards to the discounts on each side.
Of course. Thanks for that. Our partnership goes back to the 5th of December 2014. In fact, prior to that as well, when Biznews started, Standard Bank online share trading was a big supporter of ours and has continued to be over the period. And those of you who've been to on the various road shows that I've done. I mean, we've had many post Davos roadshows. We've had many post Berkshire Hathaway AGM roadshows, and at least twice a year now we try to get around to just meet and say hi to business community members as well as Standard Bank Online Share Trading. So what we decided to do was get a little closer, and the way we're getting closer is to offer Standard Bank Online Share Trading customers a 10% discount if they buy Biznews Premium. So the usual price of Biznews Premium is £4.99. You would be charged £4.50. So that's the first thing. But you have to go through this special Biznews link, which you'll find on the Standard Bank Online Share Trading website. If you are a Biznews Premium subscriber and you would like to be a member of Standard Bank Online Share Trading, in other words, if you'd like to open an account there, you'll be entitled to a 30% discount on the fees for the first 6 months. So on the Biznews side, you get your 10% forever. On the Standard Bank side, you get your discount for 6 months. And what we're doing here is saying we would like to reward those who use both of us, who use Biznews and use online share trading, because we think that it's a little bit like, if you can put it that way, our loyalty program. So if you'd like to do that and you'd like to sign up, we can give you details, and of course Standard Bank can give you details as well. But please don't forget, before I go, we've got the roadshow coming up tomorrow night, Johannesburg, at the Glenhove Road Conference Center. I'll be doing a similar presentation to this, but going into a little bit more detail on some of the reasons for the purchases. Then in Cape Town on Wednesday and Durban on Monday. If you are a Standard Bank Online Share Trading client, if you look at the picture on the screen, the little screenshot there, go down towards the bottom, you'll see Alec Hogg 2019 Roadshow and Return of the Biznews Global Portfolio. Just click on that to book and you'll have your seat secured. If you are a Biznews Premium member and you'd like to attend and you're not yet a Standard Bank Online Share Trading account holder, just drop Jeanette an email, jeanette@biznews.com, and we'll make a plan. So look forward to seeing you tomorrow and Wednesday, and then again on Monday.
Excellent. Thanks, Doc Alec.